Imagine walking into a store in New York and picking up a brand new smartphone for $70. You step outside, cross a couple of busy streets into Chinatown, and instantly flip that same phone for 120. Easy money. Now imagine repeating that move 10 times a day. Sounds like genius entrepreneurship, right? Not really. That's not brilliance. That's a glitch, a serious malfunction in the financial system that most people are too distracted to even notice. And right now, in February 2026, something very similar is happening in the silver market. While financial news channels keep viewers hypnotized with flashing red and green charts, a massive shift is unfolding behind the scenes. In Shanghai, silver prices have already pushed toward $120 an ounce. Meanwhile, in Western markets, silver is still trading around $70 or $80. That difference isn't just a pricing anomaly. It's a giant transfer of wealth taking place between East and West. So pull your chair closer for a moment. This isn't casual entertainment. If you clicked on this video, it probably wasn't random. Something told you to pay attention. Maybe you felt lately that your money isn't stretching as far. Maybe markets feel strange, unstable, manipulated. And deep down, you suspect the official story doesn't add up. Trust that instinct. Because you're right. So grab a glass of water, settle in, and give me a few minutes of real attention. This conversation isn't for casual viewers scrolling by. You're here because you're searching for answers. But before we dive deeper, let me ask something. Where are you watching from? Are you stacking silver in London? Hunting deals in Toronto? Buying gold in Texas? Drop your location in the comments so we know where our smart crowd is gathering from. All right, enough warm-up talk. Let's move straight into simple math. Not complicated Wall Street formulas, just the kind of arithmetic we learned in elementary school. Picture this. I place a crisp $100 bill right in front of you. Fresh, real, smelling like new ink. And I say, I'll sell you this for $41. What do? Call the police because you think I've lost my mind? Or pull out your wallet and buy every single bill I'm offering? The answer is obvious. But here's the shocking part. The global financial market, supposedly filled with the smartest investors alive, is refusing this exact deal. They'd rather chase overpriced digital trends or speculative assets than buy something with real, measurable value. And I'm not speaking hypothetically here. Let's look at real numbers. There's a mining company sitting on roughly 247 million ounces of silver equivalent resources underground. That number might sound abstract, so visualize it. Stack that many silver coins and the tower would rise far beyond the tallest skyscrapers on Earth. A literal treasure chest beneath the soil. Now here's where things become absurd. In today's market, companies holding silver resources are typically valued at around $3 per ounce still in the ground. That's the rough industry benchmark. But the company we're discussing, its resources are being valued at just 41 cents per ounce. 41 cents compared to $3. That's over a 700% difference. It's like walking into a dealership and buying a brand new sports car for the price of an old bicycle because someone forgot to update the sticker. In finance, situations like this look ridiculous, but for those paying attention, ridiculous often equals opportunity. And the story gets even better. Because cheap alone isn't enough. Trash is cheap too. Value matters. What separates this situation is that the company isn't struggling for survival like most small mining firms. They're sitting on roughly $55 million in cash. In the brutal world of mining, where many junior companies constantly beg investors just to pay operating bills, having that kind of cash reserve is like driving an armored vehicle through a battlefield. They don't need emergency financing. They don't need to dilute shareholders. They can survive a market downturn without panic. And now comes my favorite part, what I call the financial free lunch. Let's shift our attention to Nevada. Not casinos or neon lights, but dirt and forgotten mining leftovers. At a site known as the Hughes Project, there are massive piles of what miners call tailings. Old waste material left behind decades ago when extraction technology was primitive. Back then, miners only grabbed the richest chunks and tossed everything else aside, creating giant piles of discarded rock. But today, modern technology can extract silver profitably from what used to be considered garbage. And in these piles sit around 2.7 million ounces of silver already crushed, already accessible, sitting right at surface level next to existing roads. No deep drilling, no expensive tunnels, No complicated underground operations. Just scoop, process, and produce. Mining costs drop dramatically. In economics, they call this low-hanging fruit. I call it money lying on the sidewalk. And when silver prices climb toward levels already seen in Asia, these dusty piles suddenly transform into incredibly profitable assets almost overnight. So the big question becomes, why is the Western market still ignoring this? Why are assets like this priced so cheaply? The uncomfortable answer is arrogance. Wall Street has become obsessed with algorithms, high-frequency trading, and virtual technology hype. They've lost interest in physical assets they can actually touch. But numbers don't lie. And when reality finally corrects pricing distortions, adjustments don't happen gently. They snap, like a compressed spring suddenly released. And when that happens, the investors holding real assets will remain standing while others watch paper wealth evaporate. And here's the twist most people still don't fully understand. Silver isn't just a precious metal anymore. It's becoming the lifeblood of modern industry. And that's where our story really begins. Silver used to be seen as little more than a shiny metal for coins and jewelry, something grandparents stored in safes and collectors admired. That era is over. Today, silver has quietly become one of the most critical materials powering modern civilization. Look around you. See the solar panels popping up on rooftops across cities and suburbs? Those panels aren't just glass and aluminum. Inside each one sits silver, essential for conducting electricity efficiently. And here's the brutal reality most people miss. Once silver goes into a solar panel, it's basically gone for decades. It's turned into paste, baked into the panel, mounted on a roof, and forgotten for 20 or 30 years. It doesn't come back to market circulation. It disappears. Now add electric vehicles to the equation. Every EV requires significantly more silver than traditional cars. Charging systems, power electronics, advanced circuitry, silver is everywhere. Then think about AI servers, data centers, medical equipment, military tech, satellites, smartphones, and every smart device around you. All of them depend on silver because it's the best electrical conductor known to science. There is no real substitute. Yes, copper and aluminum exist, but replacing silver would mean larger, slower, less efficient systems. Technology companies chasing performance simply can't compromise. So demand keeps rising. But supply? That's where things become dangerous. Mining executives, the people actually working in the field, not analysts in suits, are sending out quiet warnings. Bringing a new silver mine online takes enormous time. Exploration, drilling, environmental studies, permits, construction, infrastructure. It's often a 10-year journey. And according to industry projections, no major new silver mines are expected to start production before 2030. Let that sink in. It's 2026 right now. That leaves a 4-year supply gap where demand keeps growing while supply stays flat. In economics, when demand rises and supply can't respond, prices don't climb slowly. They explode. And who saw this first? Not Western pension funds or slow-moving institutional investors. It was buyers in the East. China and India aren't buying silver for short-term speculation. They're stockpiling physical metal strategically. They're preparing for energy transitions, technology expansion, and future shortages. And that's exactly why silver trades significantly higher in Shanghai compared to New York or London. If you want actual physical metal in Asia, you pay real money. If you're comfortable trading paper promises, Western markets are happy to sell you contracts instead. But those paper promises are starting to reveal cracks. In vaults across London and New York, something strange is happening. Physical silver bars are quietly leaving. Shipments move east, containers loaded onto ships, and once they leave, they rarely come back. Western exchanges increasingly resemble showrooms selling futures contracts instead of actual metal. And when investors request physical delivery, they're often offered cash settlement instead. A polite way of saying, here's your money, but we don't have the metal. It's becoming a global game of musical chairs. Except many of the chairs have already been moved to Asia. And when the music stops, some investors will discover there's nowhere left to sit. This scarcity isn't theoretical either. Try visiting a bullion dealer today and asking to buy 1,000 ounces of silver immediately. Watch their reaction. Most will tell you they need to place an order. Delivery could take 2 or 3 weeks, sometimes longer. Why? Because refiners are already operating at full capacity and still can't produce new bars fast enough. Meanwhile, new mines remain stuck in regulatory approvals and environmental paperwork. You can't just flip a switch and create silver supply overnight. We're entering a phase where paper market abundance collides with physical market scarcity, and companies holding large, undeveloped silver resources suddenly become incredibly important. They're like water suppliers standing in the middle of a desert. This situation isn't just investing anymore. It's a resource war for the materials required to run modern civilization. And in such a war, paper money offers little protection. Only real, tangible assets hold defensive value. But now comes the crucial question. If silver demand is exploding and supply is constrained, how do you choose the right investment? Because not every mining company is a winner. In fact, most are not. Amateur investors often chase stocks that have already surged tenfold, hoping lightning strikes twice. But professionals search differently. They hunt for hidden value, overlooked opportunities. And today, I'm handing you the filter they use. For simple criteria, find a company that checks all 4 boxes, and you're no longer guessing. You're making an informed decision. Criterion number 1, a cash fortress. In mining, cash equals survival. When markets freeze, companies without money suffocate. Drilling stops, staff leaves, projects stall. But firms with strong cash reserves become kings during downturns. They can acquire assets cheaply and negotiate from strength. Look for companies that can operate for years without begging investors for funding. Criterion number 2, safe jurisdiction. Location matters enormously. A great deposit in a politically unstable country can become worthless overnight if governments change laws or nationalize resources. Invest where property rights are respected, places like Nevada, Alaska, or Canada. Sleep better knowing your assets aren't at geopolitical risk. Criterion number 3, what I call the free lunch. Projects with surface material or tailings allow production at minimal cost. No deep drilling, no expensive infrastructure. When silver prices surge, these projects generate cash quickly. Think of it as finding forgotten money in an old jacket pocket. And finally, criterion number 4, the most powerful one, valuation arbitrage. Compare how much the market values each ounce of silver in the ground. If competitors trade at $3 per ounce and you find one trading at 30 or 40 cents, you've discovered a pricing mistake. You're buying $1 for 40 cents. That gap protects your downside while offering huge upside potential. So the formula becomes simple: cash strength, safe location, low extraction cost, cheap valuation. Sounds straightforward, but patience is required. Most investors chase hype instead of quietly studying fundamentals. And when inflation storms arrive, hype disappears. Real assets remain. Now take a breath. We've covered a lot, and I know geological terms and financial comparisons aren't exactly viral entertainment. But the fact that you're still here tells me something important. You're not just watching for fun. You're searching for clarity. And in the final part, we'll talk about the most important step of all, what you should actually do next. Now let's slow things down for a moment. We've walked through price gaps, supply shortages, mining economics, and valuation filters. But none of that matters if you don't understand the most important ingredient in resource investing. And that ingredient is patience. Because here's the uncomfortable truth most financial influencers never tell you. Even when you're right, the market can stay wrong longer than you expect. Yes, we see the absurd pricing gap. Yes, demand is rising while supply struggles. But markets don't move on logic alone. Fear, speculation, and herd behavior can delay reality for months, sometimes years. And that's why mindset matters more than numbers. If you invest money you actually need, rent money, emergency savings, your child's education fund, every price drop feels like disaster. Every red candle steals your sleep. But smart investors operate differently. They use idle money, capital they can forget about for years if necessary. And that changes everything. Silver drops 10%, no panic. Prices move sideways for months, no stress, because you know you're holding something real. Think like a farmer, not a gambler. A farmer plants seeds in fertile soil and waits. He doesn't dig them up every day to check if they're growing. Time does the heavy lifting. The second thing we need to talk about is choice. Because outside this video, thousands of companies are shouting for attention. Press releases promise moonshot discoveries. CEOs appear on interviews painting massive future profits. But many of those companies are empty shells. Some have exciting stories, but no cash. Others hold deposits in politically unstable regions. Some projects are so deep underground they'll never be profitable to mine. This is why the 4-point filter we discussed matters so much. Cash reserves, safe jurisdiction, low-cost production potential, cheap valuation. Write those down. Stick them near your desk, because they eliminate 99% of bad opportunities immediately. And if doing all this research feels overwhelming, start with examples we've discussed. Study companies that fit those criteria. Read their reports. Look at management teams. Examine financial statements. Don't blindly trust anyone, including me. Develop your own understanding. That confidence will protect you far better than any tip or recommendation ever could. Third, and maybe most important, stay emotionally detached from noise. Financial headlines change daily. One week silver is declared dead. The next week cryptocurrency becomes the future. Then artificial intelligence stocks take center stage. News cycles chase excitement, but real trends move quietly. Look at reality instead. Solar panels expanding across cities. Electric vehicles replacing gasoline cars. Growing shortages in physical bullion markets. Those are signals. Headlines are just wind passing through. Right now, we're living through a historic transition. Wealth is slowly shifting away from printed paper promises toward tangible assets tied to real-world production. And simply understanding that already places you ahead of most investors. But here's something else I want you to remember. Investing is not war. It's not about beating everyone else. It's about protecting your future and creating freedom for your family. Money should give you peace of mind, not constant anxiety. And that brings us to the final stage of this journey. Because after learning all this, the natural question becomes, what should you actually do tomorrow morning? Should you rush out and buy silver stocks immediately? Should you empty your savings into metals? Absolutely not. Real investing isn't impulsive. And in the final part, we'll talk calmly and clearly about practical next steps, how to approach opportunities intelligently, and how to stay balanced while others panic. Because surviving and winning in markets isn't about speed. It's about discipline. So now we arrive at the final piece of the puzzle. After all the charts, supply discussions, mining economics, and investment filters, what should you actually do from here? The answer is simpler than most people expect. Slow down. Close the laptop for a minute. Step away from flashing price charts and social media predictions. Take a breath. Because successful investing rarely comes from emotional decisions made in moments of excitement or fear. It comes from calm preparation. When you wake up tomorrow, don't rush to place trades. Instead, start by organizing your financial foundation. Ask yourself honest questions. Do I have savings set aside for emergencies? Am I investing money I can afford to leave untouched for years? Have I researched what I'm buying, or am I simply following hype? The goal is not to chase quick wins. The goal is to build resilience. Silver, mining stocks, and real assets may present incredible opportunities in the coming years, but timing the exact moment is impossible. Markets move in cycles, often testing patience before rewarding conviction. That's why patience becomes your strongest weapon. Remember, even the best opportunities can move sideways for months before finally exploding higher. If you're emotionally prepared, that waiting period becomes easy. If you're not, you'll sell right before the move happens. Next comes discipline and choice. Keep using the filter we discussed: strong cash positions, safe mining locations, low-cost production potential, and undervalued resources. When you analyze companies through this lens, most options disappear quickly, leaving only a few serious contenders. And that's exactly how professionals operate. They don't need hundreds of investments. They need a few good ones. Also, learn to become an observer instead of a reactor. Markets are noisy. Experts argue daily. Predictions change hourly. But reality speaks quietly. Watch the growth of renewable energy. Watch electric vehicle adoption. Watch industrial demand trends. These developments tell a clearer story than any headline. And don't forget balance. Money is important, yes. Financial freedom matters. But health, relationships, and peace of mind matter more. Never let stock prices control your mood or stress your family life. Invest so you can live more freely, not so you become a prisoner of charts and news alerts. Before we wrap up, I've prepared something helpful. All the key data points we discussed, supply shortages, valuation comparisons, mining filters, are summarized in a detailed report available through the link below this video. Download it, read it slowly on a quiet weekend morning, and use it as a guide when evaluating opportunities. Consider it your backup map when markets become confusing. And finally, a personal note. If you stayed through this entire discussion, it tells me something about you. You're not here for quick entertainment. You're here because you care about protecting your future. And for that, you have my respect. If this conversation helped clarify things even a little, leave a comment or simply say hello below. It helps this message reach more people trying to make smarter financial decisions. We'll meet again in the next video, digging deeper into what's really happening behind market headlines. Until then, stay calm, stay patient, and stay safe. Goodbye.